Huge gold market crisis, LBMA bans, major Chinese refiner, and behind that headline is a development that could signal a much deeper fracture inside the global gold system. A major Chinese refiner has been pushed out of the London Bullion Market Association's Good Delivery framework. But the real question is not simply why the refiner was suspended. The bigger question is, what happens when Western compliance rules begin reshaping who can participate in the international gold market, and whether this could accelerate the separation between Eastern and Western bullion trading. For investors and businesses watching the future of gold, the consequences may extend far beyond one refinery. And what comes next could reveal just how divided the global gold market is becoming. Welcome to Currency Arc Insight, the channel focused on major developments shaping currencies, commodities, and global markets. Subscribe to stay ahead of these critical economic shifts, and comment below with the country or city where this video is being watched from. The global gold market is facing a development that reaches far beyond one Chinese refinery. When a major refiner loses recognition from the London Bullion Market Association, the immediate question is not simply whether that company can continue producing gold. It can. The more important question is whether its gold can move through the same international institutional channels with the same level of acceptance as before. The London Bullion Market Association, commonly known as the LBMA, plays a central role in the professional bullion market. Its good delivery system helps major banks, institutions, and other market participants identify refiners whose bars meet established standards for quality, weight, and responsible sourcing. For large financial institutions, that recognition can make the difference between bullion being widely accepted and bullion requiring additional checks before it can enter major trading channels. That is why the suspension of a major Chinese refiner matters. The company does not suddenly lose the ability to produce gold. China does not lose access to gold simply because one international accreditation is suspended. Instead, the restriction can affect how easily that refined gold moves into parts of the international institutional market. The issue becomes more important because the suspension is connected to a much wider policy dispute. The United States has used its forced labor enforcement framework to place restrictions on companies connected to concerns about supply chains in China's Xinjiang region. Once a company appears on such an enforcement list, the consequences can extend beyond the original border or policy decision. Other institutions may respond because they have their own compliance standards and responsibilities. This is where the LBMA becomes important. The association has its own responsible sourcing requirements for refiners participating in its good delivery system. When concerns arise about a refiner's compliance, the LBMA can review the situation and temporarily suspend recognition while that review takes place. For investors, this distinction is critical. A suspension does not automatically mean that the world has suddenly lost a large quantity of physical gold. It does not mean that Chinese consumers can no longer buy gold. It also does not mean that every bar produced by the company has disappeared from the market. The real issue is market access. A refiner can still operate inside its domestic market, while facing greater difficulty reaching certain international institutional buyers. Banks, funds, exchanges, and large professional traders often operate under strict compliance rules. They need to know where a metal product came from, who refined it, and whether the supply chain satisfies the standards required by their regulators and counterparties. This creates a powerful economic effect. Accreditation is not simply a stamp placed on a gold bar. It is part of the infrastructure that allows large amounts of bullion to move quickly between professional market participants. When that recognition is removed, additional questions can arise around the metal, and additional questions can mean additional costs, delays, and restrictions. The development also exposes a larger change taking place in the global gold system. For decades, London and other Western financial centers have played an important role in setting the standards through which institutional gold is traded. At the same time, China has developed one of the world's largest domestic gold markets and continues to strengthen its position in the Asian bullion system. That creates an important strategic divide. If a Chinese refiner faces increasing restrictions in Western markets, China still has a powerful domestic market in which physical gold can be traded. Asian financial centers can also provide alternative routes for bullion flows. The result could be greater separation between Western-accredited gold markets and Eastern trading networks. For businesses and investors, this is where the story becomes much larger than one refinery. Global commodity markets depend on trust, liquidity, and access. When political decisions begin influencing accreditation, and accreditation begins influencing market access, the structure of the commodity market itself can gradually change. The immediate impact may therefore appear limited. There may be no dramatic shortage of physical gold. Prices may not instantly react in a way that reflects the full importance of the event. But structural changes rarely become visible in a single day. They develop through repeated decisions, new compliance requirements, and changes in where buyers and sellers choose to conduct business. The key question is what happens next. If the suspension is eventually lifted, The event may remain a warning about the growing connection between geopolitics and commodity trading. If the restriction becomes permanent, other refiners and market participants may begin reconsidering how exposed they are to Western accreditation systems. And that leads to the larger issue at the center of the gold market today. Could actions designed to control supply chain risks unintentionally accelerate the development of a parallel gold system in the East, one that becomes less dependent on the traditional Western bullion centers? The real power of the good delivery system becomes clearer when the gold itself is removed from the discussion. A gold bar can contain the correct amount of metal and still face difficulty moving through the international financial system if the institutions handling it cannot verify its origin and compliance history. That is because large bullion markets are built on trust. A central bank, investment fund, major bank, or institutional trader cannot examine every stage of a global gold supply chain personally. Instead, these participants depend on recognized standards, approved refiners, audits, and established market rules. The system allows enormous quantities of precious metal to move between professional participants without every transaction starting from zero. This is where accreditation becomes economically important. The good delivery framework is designed to provide confidence that accepted refiners meet defined requirements. When a refiner remains inside that framework, its bars have a recognized position within the professional market. When that recognition is suspended, the metal does not become worthless, but its path through certain institutional channels can become more complicated. For a business, complexity has a cost. Additional verification can require more paperwork, more testing, more time, and greater legal oversight. Large institutions are particularly sensitive to those costs because they operate with strict internal controls. They also have to consider the reputational and regulatory risks associated with a supplier. This explains why the consequences of a compliance decision can extend much further than the original announcement. A rule may begin with one government agency, but its influence can spread through banks, refiners, exchanges, insurers, and trading companies. Each participant has its own risk calculations, and many will choose the safest route when regulatory uncertainty increases. The situation involving the Chinese refiner therefore represents a useful example of how modern commodity markets work. Gold is a physical asset, but the movement of gold is increasingly governed by digital records, legal standards, financial controls, and supply chain documentation. The physical bar may remain the same while its economic access changes. There's another important distinction. Restrictions affecting international institutional channels do not necessarily prevent the refiner from serving buyers inside China. China's domestic gold market is large and sophisticated. It has its own exchanges, financial institutions, investors, jewelry industry, and physical demand. That gives Chinese refiners a market that does not depend entirely on London or New York. This creates an interesting economic balance. Western markets provide deep international liquidity and long-established financial infrastructure. China and other Asian markets provide growing physical demand and increasingly important regional trading networks. If the two systems become less connected, the value of access to each market could become more strategic. For investors, this means gold should not be viewed only through the daily price. The location of demand, the route of supply, and the rules governing market access can be just as important. A change in accreditation may not immediately produce a dramatic price movement, but it can change the direction in which physical metal flows over time. The same principle applies to other commodities. Copper, lithium, rare earth materials, and energy products are all becoming more sensitive to supply chain rules. Governments increasingly want greater visibility into where materials come from and how they are produced. Companies that once treated compliance as a background administrative function now have to consider it as part of their core business strategy. For young entrepreneurs and business leaders, that shift carries a practical lesson. Supply chains are no longer controlled only by price and availability. Political relationships, trade rules, environmental standards, labor policies, and financial regulations can influence whether a supplier remains commercially useful. This is especially important when the supplier sits inside a country that has strategic tensions with major Western economies. A company can meet its production targets and still face a sudden change in market access because the rules around its industry have changed. The gold market provides a clear example of this new reality. The question is no longer simply whether enough gold exists. The more complex question is where the gold can be accepted, which institutions can trade it, and under which regulatory framework it can move. If Western and Eastern bullion systems continue developing along separate paths, the consequences could become much larger. London could remain a major center for internationally recognized bullion, while Asian markets could become increasingly important for physical gold that remains within the region. Over time, this could create different pools of liquidity with different rules and different priorities. That possibility deserves careful attention because fragmented markets do not always behave like one unified market. Prices can still be connected, but premiums, demand patterns, delivery preferences, and trading conditions can begin to differ from one region to another. The suspension of one Chinese refiner may therefore be only a small signal of a much larger transformation. It demonstrates how compliance rules can influence commodity flows without physically removing the underlying resource from the world. And the next question is even more significant. If more refiners, banks, and trading institutions begin preparing for a world where Eastern and Western gold markets operate with greater independence, which side will gain the stronger position in physical gold, liquidity, and long-term pricing power? The dispute surrounding one Chinese refiner points toward a much larger question about who will control the future architecture of the gold market. Gold has never been only a metal. It is held by central banks, used by investors, stored by institutions, and traded by businesses across borders. Because of that, changes in the rules governing gold can have consequences far beyond the companies directly involved. The most important shift may be taking place between East and West. Western markets have built a powerful system around financial centers, such as London and New York. These markets offer deep liquidity, established institutions, global banking connections, and widely recognized standards. But Asia has been building a different kind of strength, based heavily on physical demand, large populations of savers, central bank reserves, and expanding financial infrastructure. China sits near the center of that change. Its role in global gold demand gives it a strong reason to develop trading systems that can operate with greater independence. If access to Western institutions becomes more complicated for Chinese companies, the incentive to strengthen alternative channels becomes stronger. That does not mean the Western gold market suddenly disappears. It is far too established for that. The more realistic possibility is a gradual division in which both systems remain important but become less dependent on one another. Such a change would be significant because gold does not behave like an ordinary industrial commodity. A factory needs copper or lithium because those materials are used in production. Gold has another function. It can sit in a vault for years and still retain strategic value. Central banks can hold it as a reserve. Investors can use it as protection against financial uncertainty. Individuals can hold it outside the banking system. That makes control over physical gold strategically important. When geopolitical tensions rise between major economies, businesses begin to think differently about supply chains. A company may ask whether a supplier is reliable under normal conditions. It may also ask whether that supplier will remain accessible if sanctions, tariffs, trade restrictions, or new compliance rules appear later. The same thinking is now entering the precious metals industry. Refiners and mining companies connected to China may have to examine their supply chains more carefully. Western buyers may demand stronger documentation. Asian buyers may develop alternative arrangements. Banks may review their exposure. Traders may begin considering whether a particular form of bullion will remain acceptable in different jurisdictions. This creates a new form of business risk. The metal itself may remain available, but access to the metal can become divided by regulation. For entrepreneurs and business leaders, this is an important distinction. A global supply chain can look efficient when every market is open. It can look very different when political barriers appear. Companies that depend on one route, one financial center, or one regulatory system can suddenly discover that efficiency also created concentration risk. Gold provides an especially clear example because physical demand in Asia is already substantial. If Western restrictions make certain international channels less attractive for Chinese refiners, more metal could remain inside Asian markets or move through regional trading centers. That could increase the importance of local exchanges, banks, storage facilities, and bullion networks. Over time, this could affect the way investors interpret gold prices. A single global price may continue to exist, but regional premiums and delivery conditions could become more important. If physical demand becomes stronger in one region while institutional liquidity remains concentrated in another, differences between paper trading and physical availability could receive greater attention. This does not automatically mean a shortage is coming. That would be an unsupported conclusion. The more serious possibility is fragmentation. A fragmented market can still have plenty of supply while becoming more complicated to navigate. The consequences could also reach beyond China. Other countries may watch how this situation develops and consider the level of dependence they have on Western financial infrastructure. Governments seeking greater control over strategic reserves may look for additional trading relationships. Refineries may diversify their customer base. Financial institutions may expand their presence in regional markets. That is how a single regulatory event can become part of a much broader economic process. The original decision may concern one company, but other market participants learn from it. They begin preparing for similar risks before those risks reach their own businesses. The result is a feedback loop. More restrictions can encourage greater diversification. Greater diversification can reduce dependence on established Western channels. Reduced dependence can encourage new financial infrastructure in Asia. As that infrastructure grows, the global bullion system becomes less centralized. For investors, the important signal is therefore not simply whether the suspended refiner returns to the good delivery list. The larger signal is whether other companies begin changing their behavior because they believe the old system is becoming less predictable. If that behavior spreads, the gold market could enter a new phase. London and New York would remain important, but Asian centers could gain more influence over physical flows, regional demand, and long-term reserve strategies. The central issue would then become much larger than compliance. It would become a question of financial power. Who controls the infrastructure through which gold is priced, delivered, stored, financed, and ultimately trusted? And if the world moves toward two increasingly independent bullion systems, the next major advantage may belong not to the side that produces the most gold, but to the side that controls the strongest network connecting physical metal with capital, buyers, and long-term demand. The next stage of this story will depend on what happens after the suspension. The immediate decision is important, but the reaction from the wider gold industry may be even more revealing. If the LBMA review leads to reinstatement, the market may treat the event as a serious compliance dispute that was eventually resolved. If the suspension becomes permanent, however, the message to refiners and financial institutions will be much stronger. A permanent exclusion could encourage other companies to examine their own exposure to international accreditation systems. Refiners connected to sensitive supply chains may increase audits, strengthen documentation, and review where their raw materials come from. Banks may also become more careful about the bullion they accept, finance, or hold on behalf of clients. That process would not necessarily create an immediate shortage of gold. This distinction matters. Gold can continue to be mined, refined, stored, and purchased, even when one particular route becomes restricted. The bigger change could involve where the metal travels and which buyers are willing to accept it. For investors, the first signal to watch is therefore not only the gold price. Attention should also be given to changes in refinery accreditation, supply chain rules, regional demand, and the development of alternative trading centers. These indicators can reveal structural changes before they become obvious in headline prices. The second signal is the behavior of other refiners. If companies begin taking steps to reduce their dependence on one market or one accreditation system, that would suggest the industry is preparing for a more divided environment. Diversification could involve new customers, different storage locations, additional financial relationships, or stronger regional trading networks. The third signal is the movement of physical gold between regions. If more refined gold remains inside Asian markets rather than moving toward traditional Western centers, the change could gradually increase the importance of Eastern liquidity. Such a development would not mean that London has lost its role. It would mean that the global market has gained another center of gravity. The fourth signal is how governments and central banks respond. Gold has become increasingly important as a reserve asset during periods of geopolitical uncertainty. If countries continue increasing their interest in physical reserves, while global financial relationships become more fragmented, gold could gain an even more strategic role in national balance sheets. Businesses should also pay attention to the compliance side of the story. Companies involved in mining, refining, logistics, finance, and international trade may find that regulatory checks become more detailed. A supplier that appears commercially attractive today may become harder to use if its legal or geopolitical exposure changes. For entrepreneurs, this is where the gold story becomes a broader business lesson. The strongest companies are not simply those that find the cheapest supplier. They are the companies that understand how political and regulatory risks can affect supply chains before those risks become expensive problems. The same principle applies to investors. A serious investor does not need to assume that every regulatory dispute will trigger a gold price explosion. Instead, the investor can watch the underlying structure. Are markets becoming more divided? Are physical flows changing? Are institutions becoming more selective? Are new trading centers gaining influence? Those questions can be more useful than reacting to a single dramatic headline. There's also a possibility that the market adapts without a major disruption. Western institutions may continue using their existing standards while Chinese and other Asian participants expand their own networks. Both systems could remain active, with gold moving between them when regulations and commercial conditions allow it. That would create a world in which gold remains globally traded, but increasingly operates through several interconnected centers rather than one dominant framework. Such a system could be more flexible, but it could also become more complicated for businesses that operate across multiple jurisdictions. The most important warning is, therefore, not that one refiner has been removed from a list. The deeper warning is that financial infrastructure can change quietly. A new rule, a new compliance requirement, or a new restriction can gradually redirect billions of dollars in trade without physically changing the underlying commodity. For the global gold market, that could become the defining issue of the next phase. The question may move away from how much gold exists and toward who has access to it, where it is recognized, and which institutions control its movement. If the current dispute remains isolated, its long-term impact may be limited. But if similar actions begin appearing across other refiners, commodities, and financial institutions, the consequences could become much larger. The world could see the continued development of parallel commodity systems, with Western and Eastern markets maintaining different rules, different priorities, and increasingly independent infrastructure. That is the signal investors and business leaders should watch most carefully. The next major shift in gold may not arrive as a sudden shortage or a dramatic market collapse. It may appear through a series of small regulatory decisions that gradually change the direction of global physical flows. And that is why the suspension matters. It is not simply a story about one company losing an accreditation. It is a test of how the international gold system responds when geopolitics, regulation, and physical commodities collide. The final question is now unavoidable. If the global gold market continues dividing into competing financial spheres, will the traditional Western system remain the dominant gateway for international bullion, or will the growing strength of Asian markets eventually create a new center of gravity for physical gold?